Thank you all for joining us today. This is our first event of 2024, and we have a really wonderful slate all through the year. So make sure that you keep joining us every time that there's an opportunity. I did want to start by thanking our sponsor, which is United Way of Dane County Foundation, which exists to support United Way's mission of improving lives and strengthening the community. And by investing in the foundation today, you help tackle the root causes of our community's most challenging problems in perpetuity. The foundation, being as lovely as they are, has gifted us here today a $100 gift card to Gail Ambrosius Chocolatier, which is United Way's Atwood neighbor and a woman-owned business. Snap, snap, snap. Stick around at the end of the program to fill out our event survey, and your name will automatically be entered to win this gift card if you complete one. So incentives to you to help us. For those of you who are new to this group, we are Women United, a United Way affinity group and a global force of over 70,000 women making change in their local communities. Our local efforts began in 2006 when about 20 women saw the need for our community and took action to address student achievement gaps. Collectively, they raised about $30,000 to support important education programming and advocate for our Dane County children. That group of 20 women has grown into Women United of Dane County, and we're now over 1,000 members strong and continuing that legacy of igniting change at the local level. Excuse me. Today, our mission is focused on lifting women in Dane County. Through our quarterly events, we aim to provide thoughtful time and space for members and guests to set and achieve personal and professional goals while building a supportive network of women who care about our community. Through our annual fundraising, we've continued to support Schools of Hope and other important education initiatives in Dane County. And last fall, we collectively raised $60,000 to provide critical mentoring support to our Dane County children, something we're super proud of.
Thank you for that, Amy. Hello, everyone. My name is Sahadi Saidini. I am the HR manager for Plastic and Community. I have been with Women United during this past year. It's been an amazing experience and opportunity. So welcome all of you for joining. We have some exciting plans for 2024 and beyond, including the launch of our Women Employee Resource Network. If your workplace has a Women's Employee Resource Group, we would love to connect with them to bring these kinds of development opportunities to your workplace. Molly is going to share a link with you all. I also invite each and every one of you to join us in our mission at Women United. Our United Way team will drop a link in their chat to become a member, register for our next event in March, or join our LinkedIn group. We are so excited to gather this morning with our amazing network of experienced Dane County women who are ready to empower, inspire our financial wellness. Please help me welcome our friend, Ginger Zimmerman. Ginger is the president of Mercy Dufferin and a top 25 medicine super lawyer. Specializing in business law, real estate, estate planning, and entrepreneur legal services. She's also a longtime friend and supporter of United Way of Dane County through her service with our board of directors and campaign cabinet, and our 2016 honoree for the Women in Philanthropy Award. So thank you so much, Ginger, for being here with us today.
Thank you, Sahadi, and thank you, Women United, for this opportunity. I just heard before we got on, folks, that we have 121 of you who have joined us for this timely program. Welcome. And so without further ado, let's introduce our panel members who are not only leaders in their fields, but are invested in our community and committed to lifting other women along the way. Let's start with Jennifer Hannon. She's she's an estate planning, Jennifer, attorney and managing partner at Godfrey Kahn, a former adjunct professor at UW Law School, and a 2017 recipient of the Wisconsin Law Journal's Elite Women in the Law Award, which honors extraordinary women attorneys who have advanced opportunities for women in the legal profession. Welcome, Jennifer.
Thanks, Ginger.
Jennifer Ridley Hanson is the Director of Wealth Planning, a Senior Wealth Advisor and Partner at Slate Stone Wealth, and is passionate about providing financial guidance to women and families during difficult life changes, such as the loss of a partner or divorce. Welcome, Jennifer.
Good morning, everyone.
Victoria Thayer is the president and founder of Nobi CPA and specializes in helping entrepreneurs and startups at every stage of their financial journey. She's a 2023 recipient of the Wisconsin Institute of CPA's Young Professional Award and a 2023 nominee for the Athena Young Professional Award. Welcome, Victoria. Molly Vanderwielen works in the specialized lending area of UW Credit Union and was the 2024 Vice Chair of Women United of Dane County. She has a passion for helping others with their financial goals, including banking, money management, and creating healthy money habits. Welcome, Molly. And finally, Lily Avazpour has a well-rounded background of expertise. She served as a financial representative with Northwestern Mutual and recently started working with UW-Madison's Department of Electrical and Computer Engineering as a data specialist. She's passionate about helping others engineer solid financial foundations that support their dreams and ambitions. Welcome, Lily.
Hi, everyone. Thank you.
Thank you to our audience members who provided their questions and topics of interest when you registered. We'll get started with questions for our panelists, but I want to encourage the audience to add your questions and thoughts in the chat during our discussion today, and we'll have some time at the end to answer those. Now, I'd like to start with you, Lily. You have an interesting journey in the financial industry. You have a PhD in engineering and were later inspired to join the finance world. What inspired you to get yourself educated in the finance world, and why do you think it is so important for women in particular to be empowered to achieve financial wellness?
Hi, everyone. Thanks for having me here. I'm thrilled to be a part of this panel today. My journey into becoming a financial advisor is a bit unconventional. You see, a while ago, I became eligible for 401k and other benefits through my employer. And I looked at the forms and I had no idea what any of those words meant. I felt like I was reading an ancient language. The questions that stored my brain, like, am I ready for retirement? Did I have enough money saved? Was my money in the right place? Estate planning, life insurance, all those questions. And since I'm an engineer and analytical person, I started researching and learning from online courses, certificates, and I learned that women retire with 30% less saving than men. Women aren't just paid less, everyone kind of knows that earning only 82 cents for every dollar a man makes, plus women make. But we also tend to start planning later, seek professional help less often, and less likely to invest. This kind of like widens the gender wealth gap, leaving many of us feeling unprepared. Another hard truth was that financial planning shouldn't be a side hustle. It's a full-time job. Well, like on top of your actual full-time job, a full-blown adventure, and everyone deserves a map. Then turning point came. A company called Northwestern Mutual reached out to me and offered me an opportunity that I couldn't refuse, to become a financial advisor myself. This wasn't just about my personal growth anymore. It was a chance to empower others, especially women. Someone might ask why. Because it's the time to shatter the myth that financial advisors are just for wealthy or the lucky few. People like me, like you, those of us who haven't been well represented in the past deserve access to clear, practical financial guidance. I'm really excited to be here with you guys, sharing what I've learned and walking alongside you in this journey to financial literacy. So ladies, let's support each other, learn from each other, and build a brighter financial future together.
Thank you, Lily, and thank you for that information. And there probably are a number of people in our audience who can relate to your story. At this time, I'd like to open up that same question to our panelists. In 60 seconds or less, why do you think it's critical for women to be empowered to achieve financial wellness? And let's start with Victoria.
Hi, everyone. So that's a great question. So one of the reasons why I think women should be empowered is because we can change our past on our circumstances. I am a Latina, and I know how like inequalities has happened for my community. So that's also why I believe that by me making the change and empowering other women, we can change the future and we can continue empowering the next generation. Thank you.
Jen Hannon.
Similar to what others have said, Lily and Victoria have said, I think just educating ourselves empowers us, and empowering us gives us more power to take control of our own lives and destiny. And the more we know and the more we talk to each other about what's available, share our knowledge with each other, the better we all are.
Thank you, Jen. Jen Ridley.
Good morning, everyone. So some of the other statistics that we kind of looked at when we put this panel together is that at age 85, 67% of the population is female. So just think about that for a minute. So if you've walked into a nursing home lately, you see, predominantly it's women. And so I think if you're not handling your own finances today, you're delegating, you've got someone else doing it in the family, you really want to get involved so you're not learning it at the time when maybe something has happened. You've either lost your spouse or you've become divorced. And so getting involved, knowing what you own, knowing what you have, really is the way to start the empowerment. Is you got to at least start with what you even have to begin with, knowing that at some point it's probably going to be your responsibility, whether you want it that way or not. So thank you.
Thank you, Jen. And Molly.
All right. Hello, everyone. I think it's important for so many reasons. I think it empowers people to especially women, to achieve independence. It gives you security, and it gives you the ability to navigate financial emergencies that just happen in life. Also, really having control over finances helps with decision making, and it fosters resilience. And most importantly, I think it really helps you pursue your personal goals, whatever that is, with confidence, since you'll be ready for obstacles if they come up.
Thank you, Molly. Really good responses, panel. We're off to a great start. Our first topic that I'd like to start with today is really the basics, money management. And I'm going to start with you, Molly. How much money should someone have in an emergency fund, and what is the best way to go about building up that fund?
So most experts are going to recommend 3 to 6 months of fundamental living expenses as a goal. However, this is really going to look different for everyone. So it's really going to depend on your risks, what risks you have, what in your life, what resources you have. And it's also going to depend on the supports that you have available to you. For example, in the event of a job loss, how quickly can you replace your income? Someone working in a highly specialized field, that job search may take longer than someone who works in a very high demand field that could quickly get a job. So you also want to think about those risks in your life. Do you have children? Do you have enough money to cover an insurance deductible, or money set up in case an unexpected home expense comes up? So another suggestion is to ask yourself, what amount of money makes you feel secure? So the emergency fund may be the basic living expenses, but maybe you feel more secure with a little bit more. So the other thing to think about is the amount of money that's needed to prevent you from having to rely on credit or pulling from a 401k in the event of an emergency. I've worked with people that didn't have an emergency fund, and they just relied on their debt to kind of carry them through. This can really just cause additional stress and expenses, which can snowball with their financial situation. So now thinking of that 3 to 6 months padding, that may seem like a big goal, but breaking it up into smaller goals can feel more achievable. So you can do this by creating a direct deposit or automatic transfer into a separate emergency fund that's separate from your living expenses. Adding it into your budget as a separate line item, think of it like a fixed expense, is a good way to stay on top of that goal. So it's also going to be less tempting to spend this money, and you can easily see the money grow. Personally, one of the things that I've done is used a visual tool. I'm a visual person. I had a graph and I colored it in for each set amount of money to create this picture. I found it was a really good way to track and celebrate progress. So those are some ideas.
Great. Thanks, Molly. Molly, according to the CNBC, American credit card balances hit an all-time high, increasing by 40% over the last 2 years, while nearly half of users carry debt from month to month and have been in debt for at least a year. So as Americans increasingly lean on their credit cards, how can they budget so they can get out of debt? And how can someone rebuild their credit if it's adversely affected their credit score?
Really good question. Really good question. I think it affects many people. And honestly, that statistic is only going up, especially after COVID. So what I want to do is break down this question into the credit card, and then we'll go into those credit questions. So again, credit card debt can be really overwhelming. It's something that can accumulate fast if there's not a plan to have a handle on it. So I have a couple recommendations to help budgeting while getting out of debt. Number one, take account of all the debts and take time to understand the interest rates associated with each account. So from there, you can create a plan of action. Number two, once you know your rates and you see the full picture, you can choose between two methods, and you may have heard about them. The first one is the snowball method. That's where you start paying as much as you can with the lowest balance to build that momentum. And then once that debt is paid off, you roll those extra payments into the next debt. The other method is called the avalanche method. This is where you start making additional payments with the highest interest rate for the most interest savings. So whatever method you choose, though, make sure to make the minimum payment on all accounts to protect that, your credit score. Number three, you want to look for ways to refinance a debt into low-cost lending products. So one of the main tools that I use in my field is to find a security that we can use to pay down the debt, like a car or a home that has equity in it. And currently, I'm in the process of helping a member pay off over $70,000 in credit card debt that they accrued while his child was sick and he had to be home to help him. So it was a big life event that member faced, and we were able to bring down that average credit card rate of in the 20s down to single digits, and gave him a plan to pay that off. So it gave him more security that way. Number four, the other part of getting out of debt is creating a spending plan or budget. I prefer the word spending plan. This is really going to help you better understand your cash flow and find ways to cut your expenses or increase your income to put more funds towards debt. So in the takeaways, there's actually going to be a link for a spending plan that can get you started. Now for the credit question, I thought we could look at what affects the credit score in addition to talking about where to find your credit score. So creditkarma.com is a good place to get your credit score, or check with your financial. Many financials have an option to see your credit score, and they can explain that to you too. Some of them ours are within Web Branch. So the other thing too is they may offer credit consultation where you can get your credit score explained and give you suggestions on how to improve it. So with a credit score, I always tell people though, there are things you can control and that there's things you can't. We're going to focus on the things that you can control, especially if you're looking at rebuilding. So now if we can show that diagram on the credit, there we go. Perfect. Okay. So these are going to be some things that really influence your credit score. Number one is going to be that payment history. This is simply your ability to pay on time. I highly suggest setting up some automatic payments so you can avoid late payments or fees and the possibility of that later payment affecting your credit score. The next biggest portion is going to be the amounts owed, which is about 30%. The technical term that we use here in the financial world is this credit utilization ratio. And ideally, it should be kept below 50%. Ideally, I should say below 30. So normally suggest if you can 50, but ideally below 30. So this means that if you have two different credit lines totaling $5,000, ideally the total of your balance outstanding any month should be $1,500. So that even if you're going to pay it off, it's still going to affect that credit score. A really easy way to increase your credit score is by increasing that credit line so that credit utilization ratio is even lower. The next one, which is about 15%, is the length of credit history. So this is when you first begin borrowing credit. There's nothing you can do to change this, but it's simply when you started borrowing. That's why it's so important to really start early and start using credit responsibly. And then the last two, these don't affect the credit score as much, but they're really good to know. Next one is it going to be the new credit or credit inquiry? That's about 10%. So when you have new credit, it may affect the credit score in the beginning, and then inquiries are going to affect for a short period of time. So that credit report, credit score is all based off a risk. So if there's a new inquiry, whether you opened a credit line or not, it could change the credit score temporarily since it doesn't even know if you open up an account or not. Again, if you are doing a credit product that's going to put you in a better financial position, it's still the right thing. So I would still go through it. In the long run, it's going to help your credit score. And then the last one is going to be types of credit. So the credit report, the credit score really likes a variety of credit. It wants a mixture of credit cards, secured loans, especially secured loans, just a mixture of them. So again, in the takeaways, we're going to look at links to help you with these resources.
Thank you, Molly. Now I'd like to direct kind of a question again to our panelists as a group. Based on what we're doing here today in the money management aspects, what is your best advice on how to avoid mismanaging money when you do have it? In other words, how can we be more disciplined when we all know it's a lot more fun to spend it? And why don't we start this one with Jen Hannon?
One of the things I had on my list, which Molly mentioned several times, was creating a realistic budget and sticking to it. I know that's a lot easier said than done. It's like a diet that you're trying to stick to, but if it's realistic, something you can actually achieve, it's worth doing. And instead of focusing on what you can't spend money on, focus or visualize what you're saving for. And the third thing I would say, which is just a very minor thing, is unsubscribe or stop following companies whose marketing practices and products tempt you to forget your budget. If you know you have a weakness for Sephora, stop following them or whatever it is. That could help as well.
Great point, Jen. Next, I'd like to call on Lily.
So okay, let me see if I'm unmuted or not.
Okay. So there's a lot to say about this subject, but I think for me, thing that helped me personally was to categorize things that I need versus things that I want, and also shift my mindset to value experiences over possessions. Like, instead of going shopping, I would just go and watch a live music. And that helps. Yeah, they both have the same amount of it's spending. Sometimes this one might be even more expensive, but the gratification is going to last you longer. Another thing that really helps myself and my clients is delayed gratification. If you are prone to impulse buying, or some women call it stress shopping, it's called, use a cooling off period. I suggest, if you're going to a store, put the stuff that you like or you want to buy in your cart and take a walk, 10-15 minutes. If after that 10-15 minutes you still feel like you want to buy the stuff, buy it. If you want to do online shopping, put it in your cart, go have a coffee, have a tea, and then come back and see if you feel still the same. And again, the other one that I want to say is similar to what our friend said, is that I subscribe from all the temptation. Limit your exposure to your marketing emails and stuff like that.
Thank you, Lily. Jen Ridley?
Yeah, so what I was going to say is, when we talk about a money diet, budget being a money diet, nobody likes that. But I think if you want to think about financial wellness, so financial wellness means, not being in debt, kind of having a good handle on your money, having a grasp on where everything is, being able to save for short and long-term goals, which we're definitely going to talk more about. And I think maybe even giving yourself a reward. So when Molly and I were talking about what we're going to do to give for a giveaway for this event, we thought, well, if we did the chocolate, Gail Ambrosius, that's kind of a reward. So you do something good for your finances, you get the reward of the chocolate. So just like we do sometimes with children, it's like you get a treat if you finish your homework. And so, it's not that different for us as adults. And so I think having some incentives built in there, and maybe it is that you save a certain amount of money or you pay off a credit card and then you celebrate by doing something. And I like what Lily said, look for an experience And in Madison, there's a lot of free events, free concerts, free places to go. So maybe that's your reward, where you're not just spending more money. If you try to get out of debt, you're really going to want to try to stay out of debt. And so that's what I would say is just think of it as wellness, healthy habits, not eating junk food, eating really healthy things, having good money habits, I think is the same kind of idea.
Thank you, Jen. And Victoria.
I think that like also having like an abundance mindset. So like instead of thinking about it from like a scarcity point of like, oh, the things that I like previously you all had said, like previously, like, oh, I cannot have this, but instead of that, thinking about all the possibilities and what you're actually saving for and what you're gonna get in the future. So yes.
Thank you, Victoria. Molly, anything else that you need to add?
I think I love what everybody else said too. I would say plan for fun in your budget or spending plan. If you enjoy Starbucks, plan for that in your budget. But if you want to go to a concert or dancing, like plan for that you can add the fun in the spending plan or budget.
Great. Thank you, Molly. Now let's transition to long-term savings goals and tax strategies. And Lily, I'm going to throw this first one out to you. What are the tax benefits of investing in a 401k versus a traditional IRA or a Roth IRA? And do you know the differences of those different vehicles?
Investing in a 401k, traditional IRA or Roth IRA, each of them come with its own tax benefit. Contributing to 401k are typically made with pre-tax dollars, reducing your taxable income for the year that you are, contributing. Traditional IRA contributions may also be tax deductible, providing immediate tax benefits. On the other hand, Roth IRA contributions are made with after-tax dollars. So when you withdraw them in retirement, the qualified withdrawals are tax-free. Choosing which one to pick depends on your current tax situation, future income expectation, and retirement goals. As a financial advisor, if you come to me, I will try to contribute to each of them. So if you are in the future having a higher income and you want to decrease your taxable income, you can withdraw from your traditional Roth IRA. But, it's something that needs to be tailored to each individual.
Thank you, Lily. Victoria, how do those that live in a gig or side hustle or are self-employed individuals save for retirement if they don't have a 401k benefit through their employer?
Yeah, that's a great question because again, like those are one of the first challenges that self-employed people will face. And we have several options. So as previously Lily mentioned, we have individual retirement accounts, which can be the traditional IRA account and Roth IRA accounts. Again, like similar to what Lily said, like if it is a traditional, we're thinking about like, okay, I'm getting a deduction now instead of being a Roth. I am going to pay taxes now, and then it's going to be tax-free once I start doing my draws. Important to mention that both Roth and traditional IRAs for 2024, the limit is $7,000 for 2024. And again, like these are different vehicles that clients can use to save. And I will also piggyback right on Lily's that like it's good to like diversify on different like methods to save. So another very, very common one that I'm always seeing and I'm always working with financial planners for my clients is the SEP IRAs. So the SEP are easier to set up, and they're easier to manage for like someone that is a solopreneur. And again, like the limits are pretty large. So it's $69,000 or no more than 25% of the compensation of the self-employed person. So this really gives a lot of room for the person to save. So that's a huge one and very common one that we keep seeing. So that you are aware, there is also something called the solo 401k that is designed for self-employed individuals that don't have any other employees. There's also the simple IRA too, because that one not only allows the self-employed person to contribute, but also do a contribution from like a matching perspective from the business side. You can also use health savings accounts as a way to save money for retirement, because that you can be using for like medical expenses in the future. And again, like going back to what we were talking about at the beginning, the budgeting and the saving, having that discipline, and it's going to be even more important when you're self-employed, because you don't have that automatic like draw out of your paycheck. So you have to be disciplined. Same thing, just put a schedule, just have an automatic draw so that you are saving towards this account every single year. And again, work with your tax professional and your financial planner. And you're going to need both of them to work in cooperation to know like what are your limits, what is the max that you can contribute. And yes, it takes a team effort, but yes, hope you will start doing it.
Victoria, are there any tax credits that the average person overlooks, or are there any that benefit women in particular?
Yeah, so I would like to focus some attention into the child tax credit. Again, like remember that it's $2,000 per child that are under 17. One portion of that is actually refundable. So even if you don't owe any taxes, please still file the 1040 return, because you can still actually get money back. So it's sometimes like women tend to think, oh, I don't owe any taxes, like I didn't make any money, but like you can actually get refund back from these like refundable credits. Another big one that I see people miss is the child and dependent care credit. So these is a credit that covers a percentage of daycare costs for dependents up to 35% of I think it's about 3,000 of like the expenses for one dependent, or 6,000 if you have more than one dependent. And the thing that people miss the most is that people think like, oh, my kid doesn't go to like a daycare. Oh no, but they are going to summer camp. Summer camp expenses actually count towards that. So you don't have to be going, it can be even like a preschool. It doesn't have to be like a stereotypical daycare. If you're paying someone to come and take care of your child, that also counts as well as a expense for this credit. So again, like that's, and like summer camps, I feel like that's a pretty common one and that people don't count it towards it, but yes, it helps a lot. The other ones too that I want to bring to your attention, and I know like we're empowering women over here and we're, continue education, continue growing. Two very important credits to remember: American Opportunity Tax Credit. That one is mostly designed if you're thinking of going back to college. And there is the Lifetime Learning Credit. So even if you already went to college, you already claimed the original American Opportunity Tax Credit, but now you want to do, after like you want to do like a certificate, you want to do like a graduate school, like master's, then you can apply for that one. Again, there is some thresholds depending on your income. So you will have to do a little bit more reading or work with a tax professional. Another one, the student loan interest deduction. Remember that these can be deducted from your taxable income. We also have the adoption credit. So you can get up to $15,950 for all the expenses that you incurred during the adoption process. You also have the earned income tax credit, which if you're in the low income bracket, you can get this credit as well. And if you are like in the lower tax brackets, you can also get a saver's credit. So actually the IRS is actually encouraging us to save for retirement. So you can also get a credit for that if you fit in the thresholds that they set every year. We also have the health savings, the HSA health savings account deduction for the contributions that you make for that year. If you are a self-preneur, then you also have the home office deduction. That's a huge one that sometimes people miss. It's like if you have a space of your house that you're using for business, then just make sure that you tell your tax preparer or you enter the information in your tax software so that it's calculated, as well as mileage too. That's a big one also for business owners. And then we have the solar tax credit, which is like 30%, which if you guys are doing any renovations or things like that, just check to see if your new furnace qualifies for the energy efficiency. And that's a pretty straightforward tax credit too. Don't miss. So yeah, I think those were a lot.
Just a few there, Victoria. I think what it does demonstrate is there are opportunities, and
Yes.
we should all take an opportunity to meet with our accountant and determine what applies for us.
Yes.
Now I'd like to direct the next question to Jen, Ridley, and Lily, if you could join in as well. Some 401ks have automatic investing. Is that a good idea, or should we be trying to figure out our own investment options in our retirement plans? And if the latter, where does someone even begin?
Yeah, so I'll start and then Lily, you can chime in. You know, I would say honestly, any investing in a 401k is better than not. And so the automatic, I think, was really designed for employees who really didn't know how to contribute or couldn't start contributing, kind of get them in a plan. And so I would say, like I said, any investing is better than none at all. You know, I think generally you're going to want to look at what kind of risk tolerance do you have, which is something, again, you can spend kind of a lot of time thinking about, you know, the long-term nature of a retirement account. For most of us, we've got a couple of years at least until we're going to retire. So you've got time, the time value of money, the time to ride out the markets if they go up and down, which we know that they're going to do. And so I would look at the options within the plan and then see what seems reasonable. A lot of times retirement plan will have reports on all the funds within the plan. So you can look at a report and say, and it'll tell you, this is conservative, this is moderate, this is aggressive. So, you know, there you can kind of figure out, what really feels right to you. Sometimes that report will show what the earnings have been of that fund, how much money they might have been down one year. So think about in a year when the markets are down, how will you feel about your investments? Are you willing to stick with the plan, knowing again long term that those things get smoothed out over time? And so again, like I said, I don't think there's really any wrong way to do it. I think the one thing I would say for women in particular, women tend to be much more conservative than they really ought to be. And I think it's a matter of personal opinion and personal preference. But I think the more educated you are, the more willing you are to take those risks, because they're not risks that are, you know, you're not gambling. I mean, you're investing in companies that you should recognize. I mean, that's how we approach this. And so I think, again, I would caution women in particular to being so conservative that you end up basically not earning enough to really support you through retirement. So Lily, did you want to add anything to that?
That was awesome. You already covered so many things. Yeah, definitely having the automated investing has its own benefit to set it and forget it. And with our busy lives, it's a good option. And it's consistent and it's disciplined. So you are not like nudging anything. And then the drawbacks are that you have a limited control and there is less learning involved, and there are usually like fees associated with these automated services. But if you are interested into manually investing, start with the basics, as Jen said, like research the fundamental of investing concepts like asset allocation, diversification. What does it mean to evaluate your risk tolerance? And then review your plan options, and definitely choose a low cost, diversified fund and that has a good track, and make sure that it matches with the goals that you have. Like, how do I want to live in my retirement? Do I want to keep the same level of comfort that I have now, or do I want to be more comfortable? Do I want to buy yacht or something like that? And then one thing that I wanted to add is that if you are taking care of it yourself, you have to rebalance it periodically. Usually if you're a business owner, I suggest every quarter, but if you are like, you know, an individual, you can just look at it every 6 months or every year and make sure that, you know, your portfolio is maintained and is like, you know, optimized.
Great, thank you both. Just kind of to pull that all together, The automated funds can be helpful for people who are a little adverse to trying to do it on their own or don't have the time or something of that nature, but you'll lose the control. And if you have the time and have the desire, you can learn to invest on your own. But based on what I'm hearing, I would tend to look for someone that I could trust, like Lily or Jen, and get their help in doing it when I get started so I can understand it and go forward. Thank you both for that. Our next topic is something for which we rarely plan, but the information is critical because it is more likely to impact women adversely. According to the American Psychological Association, approximately 40 to 50% of first marriages end in divorce, while 60% of second marriages end in divorce. Additionally, after a divorce is finalized, men hold 2.5 times the amount of wealth than women do. And on average, women's household income falls 41% compared to 23% for men. However, we can plan for this. So Jen, Ridley, join me in the practice of hope for the best and plan for the worst. For married or domestically partnered folks, what should they do now to prepare for and protect themselves from the impact of a divorce?
Yeah. So again, nobody sets out to get divorced. I mean, I think that's, something unfortunately that happens quite a bit based on the statistics. So I think the main thing really is to be aware of the family finances. So know what you own, know where the bank accounts are. Please do online banking, look at the accounts. I think a lot of women that I meet, and they maybe were in a marriage where they raised the children, they were there to kind of keep the household running. They just didn't really handle the finances. And that wasn't because they weren't smart enough. It's that it just wasn't their job. And so I think when someone like that comes to the point where now all of a sudden they're facing divorce, some of these things they've never seen, they don't know where the money is. And so that puts people at a really big disadvantage. And so I think knowing what you own, just being aware of the assets. And I think also having your own retirement fund, as we just talked about, having accounts in your own name that are things that you control, that you're investing. If you do get to the divorce and you start to split things up, oftentimes each party kind of leaves with their own retirement funds sometimes. And so you might have something that you can kind of start with and take with you. You can continue to build on for your own retirement. And so I would say, don't be naive and think that like it'll never happen to me, because unfortunately, sometimes it can be a surprise. And so, as a financial advisor, I decided to specialize in divorce financial planning because of the situations that I came across. And so I saw so many women who got to the point where like they kind of threw the towel and said, I don't even care anymore. Whatever happens, I just want it done. And I think, my role at that point is to say, no, we're going to fight for what you need. I'm going to protect you for the rest of your life because I'm running a financial plan based on the proposed settlement of the divorce to show how my client is going to fare when she's 85 years old. And so the only way to get to that point that we're comfortable throughout retirement after divorce is to make sure you're ending up with the right split to begin with. And that again is something that, it's not easy to come to that, but if that's what happens, you really need a team around you that can advocate for you, that can really help you navigate that very scary and very difficult situation.
So it sounds like a lot of this planning can be done probably on their own without a lawyer. Is there a point in time when your team needs to require the lawyer?
I mean, I would say absolutely. So you can legally get divorced without an attorney. I think, again, I would not recommend that only because there's so many things that could get missed. I mean, there's so many things that could get overlooked. I think, again, without having someone really advocating for you, if you're not the one who knows where all the money is, and you might put yourself in a position that, you can't really fix. And so that's where I would say I would not do this alone. I would hire a great attorney, and we know lots of them. We've got a great community in Madison. We all could recommend several that we've worked with. And so I wouldn't do it alone. I think you're just setting yourself up for more trouble down the road. And I think the problem is, it's very expensive. However, the money you're going to spend on getting the fair settlement is going to help you have the more money you're going to need when you get through the divorce and kind of rebuild your life, rebuild your credit, rebuild everything, rebuild your retirement, whatever you need to do to recover from the divorce. You need to kind of have the right people in place who will help advocate for you to get that settlement.
Well said. And remember, we all have rights. And so it's important to make sure that we're protecting those rights, even in those situations. So we're moving right along today, folks. Our final topic now focuses on estate planning. And I think when people hear estate, they think that's for the really wealthy or ultra wealthy. And they don't have enough assets to even bother undertaking basic estate planning. Many people think writing a will is important, but no one likes to plan for their own death. So it's something that continues to get put off. I'm going to call on Jen Hannon now and ask her for our estate planning questions. Jen, can you tell us why estate planning at any age is so important? And does the type of estate planning needed by an individual change over the course of their life?
Thanks, Ginger. I would say that everybody needs an estate plan, but it will look very different for everyone. Some of them, let me just take a step back. An estate plan means many different things. It may mean, what do the beneficiary designations on your life insurance and retirement accounts say? Do you have transfer on death designations for your financial accounts like bank accounts? Are they titled? Do you have accounts that are titled jointly? You know, how is everything titled? Who is entitled to it at death? Your will generally only controls assets that you own at the time of your death that are in your sole name and that does not have a beneficiary designation. So if you own all of your assets jointly with your spouse and you pass away, all of your assets will go to your spouse. If you have beneficiary designations on every single asset you own, they will go to the beneficiaries you've designated and will not go through your will. So just with that level set, there are many different stages that people go through in their life that usually affect their estate planning. The first I would say is young adulthood. So for any of us who have children who are 18, they should absolutely have healthcare powers of attorney in place. If anything were to happen to them, where they could not make their own healthcare decisions, you as their parent cannot make their decisions after they're 18 without either a healthcare power of attorney in place or going to court and obtaining a guardianship. So for all of you who want to not have to go through that difficult situation, especially when you're already dealing with an emotional situation of your child being hurt, definitely get healthcare powers of attorney in place. Financial powers of attorney may also be important depending on what finances your kids have, but that would allow you to assist them with banking and other things as they mature. Both of those forms are freely accessible and available through the state of Wisconsin's website. So it's not something you have to hire a lawyer to do. That's very easy. And that'll be one of my takeaways for if you don't have them yourselves, you should have them, as well as children who are over the age of 18. The next phase of life is typically, maybe it's you're entering into a partnership or a cohabitation or a marriage with someone. Perhaps you need to address marital property laws, titling of assets, beneficiary designations, and making sure that those are all in line so that if you want your spouse to benefit or your partner to benefit from your assets upon your death, your estate plan addresses that accordingly. The next phase may be children. You're having children now and you want to make sure that your children are provided for if you are no longer able to. One of the things you have to do in a will, the only way to nominate a guardian is in a will in the state of Wisconsin, so that you can write a piece of paper that says this is who I want my guardian to be, but the only recognizable document by the court will be a last will and testament that's witnessed by two people. So that's something that definitely should be in place. And you may also be thinking about at what age is it appropriate for my kids to get access to their inheritance? Is it 18? Is it 25? Is it 30? You would talk with your advisor about that. Then you go through the period of building wealth over the course of your life. And as your assets grow, perhaps you have different tax consequences, which change how you want your estate plan to be drafted. Right now, our estate tax exemptions are through the roof. Each person can transfer $13.61 million free of estate tax. So for a married couple, you're over $27 million. Most people are never going to have to worry about an estate tax under that system. However, the estate tax is a very political tax and the exemption has been all over the map in the last 20 years. It was, when I started in 2000, it was $675,000 and now it's over 13 million. And it is scheduled to sunset the exemptions in 2026, at which point we estimate it'll be around 7 million per person. Again, still very generous, but something to keep in mind. Then, as what may occur during some period in your life is a separation or a divorce, which Jen Ridley Hanson mentioned. So that's something you may need to adjust your estate plan to remove a spouse or a partner who you had previously included as a beneficiary of your assets or designated as a fiduciary. Perhaps that person was designated as your healthcare agent or your financial agent, and now they no longer should be in that role. Another next stage is retirement. Like when you get to retirement, excuse me, do any changes need to be made based on the fact that your income may go down, or maybe it'll go up depending on pensions and other things, and should it be adjusted at that point? And if at any point in your life there's an inheritance that might significantly increase the value of your estate, should you also be adjusting your estate for that reason? Because now maybe you're dealing with a tax situation that you need assistance with. Regardless of the stage of life you're in, we generally recommend that you look at your estate planning documents every 3 to 5 years to confirm that whatever you've done still makes sense. And that means the beneficiaries that you've chosen are still the right beneficiaries, and the people you've chosen to act in fiduciary roles like a trustee or a personal representative, a healthcare agent or a financial agent are still the right people to be designated.
Jen, what happens if I die without a valid will or trust in place?
So, as I mentioned earlier, wills only govern assets that are owned in your individual name at the time of your death that don't have a beneficiary designation. So if you have an asset like that, a bank account or an investment account or real estate or whatever it is, and it needs to be addressed, the state of Wisconsin has a default will for you in its statutes. This is referred to intestacy or dying intestate. In that instance, someone would file a petition with the court in the county in which you died in, and you would nominate someone to be the executor of your estate. We call that a personal representative in Wisconsin. And that personal representative would be tasked with gathering and distributing the assets in accordance with the intestate laws. So if you are married, and well, first let's start. If you're single, your assets are distributed to your descendants if you have any. So children, grandchildren, and down the line. If you're single and you do not have children, your beneficiaries would be your parents. And if your parents are deceased, siblings are gone, nieces and nephews. So kind of falls down the parental line if you don't have any of your own children. If you're married and you have no children, your spouse receives 100% of your estate. If you're married and you have children from that marriage, and those are the only children you have, your spouse also gets 100% of your estate. If you're married and you have children from a prior relationship, 50% of your estate goes to your children from the prior relationship and 50% goes to your spouse. If you do not want your assets to be distributed in the way that Wisconsin law lists its default provisions, that's why you should have a will and or updated beneficiary designations and things like that to make sure that your assets go where you want them to go. And also you're picking the person who's administering your estate instead of the court.
Thank you, Jen. I have some questions now from, well, before I go to the questions, I have one other question that I want to ask the entire panel, and we'll go through the panel. In 60 seconds or less, if you can, what would be a good place for our participants to start if they want to learn more about the topics you've covered today? So Molly, we'll start with you. Where can our audience go to start taking control of their debt and money management?
Okay. Number one, check your credit report. That's the biggest thing. You can go to annualcreditreport.com. They're the only government regulated one. You're going to pull from all three. It's not going to be an inquiry because it's specifically for you. So to pull from TransUnion, Experian, Equifax. So now ideally all three of them should say the same information, but over half of them, they don't. So you want to make sure that any inaccuracies that it's corrected, or if there's a late payment on there or a judgment, or you've already paid that's corrected, and that can be done online. And then from there, create a spending plan. Go to Credit Karma, visit your financial, or the Dave Ramsey website if you kind of are further along.
Thank you, Molly. Lily, where should we start to get on track for long-term savings and retirement?
So for that reason, as I mentioned before, first of all, you have to estimate your retirement needs, figure out your desired lifestyle, and estimate living expenses in retirement. Then you estimate your resources, calculate how much your current savings is, how much investment do you have, and your potential future income sources. Once you have these basics, compare your need to your resources. If there is a gap, take action. Start automated saving withdrawal based on your budget and take advantage of max match from your employer. Nowadays, the employers even are offering Roth contribution as part of their 401k package. The employer contribution is basically free money, so maximize it if you can. And then at the end, if you need more help, seek professional guidance from financial advisors. You can find free advice from your financial institution, and so many different institutions offer a few sessions for free, and you can like hire someone that matches with what you are looking for, what is your goal, and move from that, or do your research, read some books, and go on YouTube. I put some resources in a draft that we are going to share with the audience when we leave, and they can go and take a look at those for more information.
Thank you, Lily. Victoria, how about tax preparation and making sure we're getting the most out of available tax credits? Where do we start?
Yeah, so I would say first, like, gather all of your documentation, and the laws are always changing for taxes. So always work with your financial planner or tax professional. But a good way to get like some knowledge is the YouTube channel for the IRS. Those are actually pretty useful short videos that they're very straightforward, plain English. And also Dream Bank also has several like personal tax classes and webinars with just like things to be aware of. And another one that here, if you're local to Madison, there is the Reacher Daily Tax Center. They do free tax filing if you qualify. It's a good place to also check out. And yeah, I think that those will be it.
Thank you, Victoria. Jen Ridley, where should women start if they want to ensure their financial security in the event of a divorce?
Yeah, so like I said earlier, have a good handle on what you own, what accounts are there, where are all the bank accounts, kind of just have a good sense of that. And it can even start as simple as when a statement, I know a lot of people get paperless statements, but if you get statements in the mail, it's really handy to pull those statements aside, write down like there's an account at UW Credit Union, it's a joint checking account, just know where everything is. I think, again, a lot of times you're kind of putting yourself at risk if you have no idea of anything financially related to the household. That's not a great place to be. I think the other thing I would say, and again, this is a really tough one, is it's really hard to take the emotion out of a divorce, because obviously it's like ripping your entire world apart. Okay. So like, I get that it's emotional, but I think you've got to separate the emotional part of it from the financial part. And sometimes women in particular tend to have the emotional decisions that cannot be the best financial decisions. So like, for example, the biggest one probably is, women typically want to keep the house, especially if there's young children still living in the house. And that, may or may not always be the best idea. And I think some women have said, I don't care, I just want the house and I'm not going to sell it. And sometimes people have to give up other assets to keep that house. And then what happens is, if there's a mortgage, you may not be able to continue paying it. There may be challenges in owning that house and having to, hire people to plow your driveway, right? Living in Wisconsin. So I think just being aware of, you've got to have someone on your team who can really steer you in the right direction and understand the emotional side, but help you make the best financial decisions.
Thank you, Jen. Jen Hannon, where should our audience begin if they need to start the process of estate planning?
So my answer is almost identical to Jen Ridley's. So definitely prepare a list of assets, which includes a description of each asset, how it's titled, where it's located, and whether it has a valid beneficiary designation. That'll tell you right off the bat, is there anything that I own that will actually be distributed by my will? Or is everything going to go either pursuant to the title or pursuant to some kind of beneficiary designation? And then review each beneficiary designation you have in place and confirm it's current. with all of our employers and different easy ways in which you can open accounts here and there, we don't always look at all of them. Another thing I would say is, to the extent you can, don't have accounts at 15 different places. Try to consolidate your assets so that it isn't hard to track down. And this can be for, maybe it's simple because you're going through a divorce, or because you're going through the estate planning process, or you're just getting your taxes together. You know, you're waiting on 15 different 1099s. But I think having just a consolidation of your finances and making sure that that's all in order. And then I would also keep a list of people to contact in the event something happens to you. So that if you do have an advisor, a financial advisor, or an accountant, or an attorney, make sure that your loved ones know who to call in the event something happens to you, because they may have some paperwork in place, making it easy for your loved ones to address this difficult situation.
Thank you, Jen. Now, let's go to our live question and answer. Our United Way friends and team have forwarded to me questions from the chat, and I will try to direct them to the right panelist. If I miss somebody else, feel free to jump in. I'm going to start with our first question. And Lily, can you touch upon what a good amount of life insurance someone should have, and what percentage of one's income you suggest they should be contributing to retirement?
So for life insurance, usually it's a very individual thing to take care of. For example, if you have kids, how old they are, how many years they are going to live off of your, your life insurance that is in place, how much you can contribute. For example, if you are making good living, if your income is big enough, you can buy whole life insurance, which is a vehicle that you can use for kind of like, it's not right to say saving money, but it can be useful for your retirement years. If you have a financial advisor, they can use that they can leverage that and kind of like help you not to drain your retirement by getting a loan against that life insurance. But for the life insurances that the employers offer, I suggest, buy as much as you can, as much as they offer. One drawback to buying life insurance from your employer is that if you quit, if you get fired, you can't carry it with you. So I always suggest, have some from your employer and then some from a private company. And for the contribution to 401k, to be honest, as much as you can. My idea is to max it out. If you can afford your living expenses and you can put enough towards your short-term goals, you want to buy a house, you want to replace the roof, just try to maximize that, because you will get that free money that I was talking about from your employer matching your contribution. But again, it is really dependent on how much debt you have, how much money you have to spend, what is your essential budget, and stuff like that.
I imagine too, if there's a match with your employer, that might enter into part of your process. Is that true, Lily? If your employer matches to a certain amount that you contribute, that might be something to consider as well.
Yes, definitely. But I don't I suggest don't stop there, because they might match your 401k, but then you can't contribute to Roth IRA and maximize that. I want Jen to pitch in and tell me what she thinks.
Yeah, no, I think that's right. And I think I like what you said too, Lily, is, you got to really be able to balance the short-term and long-term goals together. And I say I would try to do both. And I think it kind of ties into with like paying off credit card debt. So some people think, well, I got to pay off all my debt, then I can start saving for my cash reserve, then I can start retirement. I say do it all at the same time and find a way to do it all. So maybe it's a little bit towards each and start it all at the same time. Because I think the longer you wait on retirement specifically, you're losing years that, again, like I said, if you're going to live as long as we all hope to, you're going to need that money for retirement. And so starting small today and kind of spreading it out, don't get in the mindset like I must do everything. I can't do it all at once. You can really combine the savings goals. That's what I would suggest.
Thanks, Jen. That's a great segue into another series of questions that we received from our audience. Molly, I'm going to turn to you to answer a couple of these. I'm going to combine a couple. One question says, I heard once that paying off your credit card completely every month or paying it down way before the due date negatively affects your credit. Is this true? And in connection with that, there's another question that talks about, I know canceling or closing a credit card is bad for our credit, but how bad? I don't want the temptation of having that available credit. Do you have any thoughts on that, Molly?
Yeah, good questions. And I mean, it is definitely out there, especially with the credit card one where you just, pay off the full balance. And before the due date, actually, that's a new one I've not heard of. So the credit report, each financial only reports one time a month to each of the credit reporting agencies. So they want to make sure, I mean, obviously there'll be late fees if you pay past the due date. But the due date one, I mean, with them only reporting once, it's not going to make a difference. And then paying off the balance, as long as you keep it open, maybe that's where it kind of goes back to, is to keep that credit card open. You have to use it. I think ours is once every 18 months. That would be important that way. But to pay it off every month is going to help that credit utilization ratio that we talked about. So yeah, I would say both of those are myths. And then the other one about closing or canceling, that is, you want to look at the full types of loans that you have. If it is the one that you've had the longest, it could affect your credit score. Now, if there's other credit products out there, so if you have other loans, or if there's an option for a loan. So for example, if you have a home equity, at the credit union, we have a loan or line option. You would want to go into a loan because that one would make you, it would probably be better suited for you. But closing or canceling, I mean, it could affect it if it's your longest term one. But if you have a mixture of other credit products that are out there, you should be okay.
Great. One last credit question, Molly, and then I'll let you off the hook here. It has to do with your length of credit history that you had on the slide. Based on this factor, what is the best age to start building credit history for your kids and how?
Yeah, great question. So you can start your credit at 18 years old. And now not every 18-year-old, of course, is ready for that. But that's when the credit score really that's when the credit score can be established. And I would say start small. I mean, you can start with a $500 overdraft protection line, and then it's just going to grow from there. So that length, I mean, normally what we do is we go back 2 years, right? We look at the last 2 years, how much credit has this person had. So 2 years is kind of the key factor. Start early. There was another question, I think, in the chat about authorized user, and not all financials report that you're on that person's credit if you're an authorized user. So that's the other big one. Is that even having an authorized user may not help that person. It's really getting that line established. And again, you can start small and then you'll just grow from there, because it's all about showing responsibility and then growing from there.
Thank you, Molly. Victoria, we have a question that was directed to you from our audience.
Okay.
Does the adoption tax credit apply to same-sex couples where the non-biological person has to adopt the child?
Yes, it does apply. Mm-hmm.
Is there anything special they have to do?
No, I mean, like, there's a specific requirements. I don't have them out of the top of my head, but I have worked on things like that before. And then the requirements every time they change, and it's a huge items that you have to collect and provide while you are preparing your 1040, which is due on April 15th. So yes, so I will recommend that you go to the IRS website, and then in the search bar, just put adoption tax credit, and it's gonna give you like frequently asked questions, and that will be the best place to start because it's more plain English of what you need.
Okay. Jen Hannon, one just flew, but what about in terms of the estate planning and the issues that arise if both parents pass without leaving anything in place for the care of their children? What happens then?
In that instance, the court has to appoint a guardian, and they base who that guardian will be on the best interests of the child. The child is over the age of 14. The child can state their wishes regarding who their guardian is or becomes, but the court isn't obligated to follow that child's wishes. Where this becomes particularly difficult is when you have family members who are fighting over who is going to be the guardian of the child. And in that case, it would likely result in litigation with both sets of family members who are interested in becoming the guardian, trying to convince the court what is in the best interest of the child. So if the parent knows that there could be a dispute over who becomes guardian, it's especially important to make your wishes known in that will.
And another question for you, Jen Hannon, and this is the other kind of spectrum, and that is, do you have any tips for how to bring up the difficult conversation about estate planning with senior parents who may not be forthcoming about what they're doing?
I wish I had a dime for everybody asking me that question. The older generation does tend to be a lot more private about their estate plan than maybe some other generations are. I think the younger generations are they're used to sharing everything. So whereas money and death and things were very taboo for the older generation, the best thing I can suggest is expressing to them that you want to make sure that you are following their wishes, whatever they may be. And in order to ensure that you are following their wishes, having a conversation now versus trying to figure out what it is, what they meant or what they intended later when they're no longer here is much easier. But pushing them usually doesn't work. And honestly, there are some people who never talk about it with their children, and eventually it all becomes known when the will is produced or the estate plan is produced and people read it. It's not the worst thing in the world. Most people, though, ask me this question because they're concerned their parents have not done anything. And they're trying to spur them to do something. That may not be the case. It may just be that they don't want to talk about it with their children.
Thank you. How true. Jen Ridley, how can you find out what marital assets are if your partner isn't forthcoming?
Yeah, that's a tough one. That's a tough one. And that, again, could be a sign that there's trouble. I guess I would say if someone's not open to a conversation about things you technically own jointly or that are for the benefit of the family, I'd be a little bit worried about that. I think in general, and again, I'm not an attorney. We've got attorneys here on the call. And again, plenty we can refer you to if you get in that situation. But I think, in general, Wisconsin is very liberal, I think, in terms of what they want to give each of the spouses. So Wisconsin has a pretty unique property law. And so, usually it kind of starts with splitting everything 50-50. And so usually that's going to include all the accounts that you would think of. And so if somebody comes into a marriage with separate property that they've kept separate from an inheritance, that's a little bit different. And that gets a little bit tricky. But if it's stuff money that you earned together in the marriage that went to contribute to accounts that you have together, usually those are things that would be considered marital property or marital split in a divorce. And so I'd say you probably start with like everything you own and then take away whatever wouldn't qualify. But I'd say for most couples, pretty much everything you have is going to be on that list of assets potentially up for splitting.
Thank you. Jen Hannon, how does the inclusion of charitable giving fit into estate planning, and what benefits are there for both the individual and the charity?
So charitable giving can be, of course, done during lifetime, in which case you would get an income tax charitable deduction for the gift you made to the public charity. And similarly, at death, when you make a gift to a charity at death, you receive a deduction for estate tax purposes. As we talked about earlier, the estate tax exemption is really high. So for those people who are under that threshold, that deduction won't help you because you won't pay tax anyway. So we're seeing more and more people do a lot of their charitable giving and estate planning during lifetime. And that might be a simple gift. It might be utilizing if you're at the required minimum distribution age for your retirement accounts, perhaps you are doing a qualified charitable distribution from your IRA directly to charity. So the charity is getting a portion of your RMD each year instead of you, which means it's not taxable to you. It goes directly to the charity. But overall, there's a lot of sophisticated charitable planning techniques you can also engage in that we would constitute estate planning, like charitable gift annuities, charitable trusts, all of which you could, depending on your personal situation, could speak with an estate planning attorney about and get more information on what makes the most sense so that you can maximize your deductions and also accomplish your charitable goals.
Thank you. Lily, we often hear that we shouldn't withdraw from our retirement funds. But is it ever okay to withdraw retirement funds to make major financial moves, like using it for a down payment on a house or continuing education? She's muted. Can we unmute, Lily? There we go.
Okay, got it.
Thank you.
Sorry. That's a very tricky question because my idea is that if you are saving for your future and you are trying to use the benefits of compounding and using the tax benefits of 401k contribution, you should never touch that money. But it depends on what your personal preferences are. Definitely, early withdrawal, it will cause a penalty if you withdraw in most circumstances before the age of 59.5, you will face a 10% penalty on top of the income tax. You might lose some of your retirement saving and you increase your debt burden. But I have been experiencing, like, clients who withdrew from their retirement saving account. And at least one thing that I can ask you to do, if you withdraw some money, try to pay the penalty and the fees and taxes from your own money, because withdrawing those expenses from your retirement is going to cost you more than your own money. I don't know if it makes sense or not, but definitely some things like career advancement, education, and stuff like that can lead you to make more money. So it might be worth it, but it's a very individual decision to make.
Thank you. Molly, if I have multiple sources of debt, credit cards, student loan, personal loans, car loans, how do you suggest I prioritize the payment of those?
Good question. Number one, I would look at the interest rates, like what's the highest interest rate? And then the second part is, what kind of loan is it? So normally, even with the credit report, the way that the risks go basically is anything unsecured. So credit cards, personal loans, that's going to be kind of on the lower portion. Second portion is going to be student loans. And then the other portion is going to be like a car loan, and then a home loan is going to be kind of on top. So I would say any unsecured debt is going to be the priority. And then that's when you can kind of go back and look at the tools that I talked about. And then after is really look at those interest rates. That's the biggest one. A lot of times credit lines will be variable. So right now prime is at 8.5%. So it's pretty high because it's probably prime plus 10, 15, maybe even 20% higher. So they could vary and go up and down. compared to your fixed loans, which you know that what that rate's going to be, and it's guaranteed. So really look at that interest rate.
Great, thank you. Just watching our time here, we're getting a little close. I'm going to throw one last question out here to Jen Ridley. If you have a retirement plan from an old employer, and they're no longer there, are there benefits for leaving it there versus transferring it to a different account?
Yeah, actually, that's a great question. That comes up quite a bit. And I think what I see sometimes is people have little retirement plans spread out through like multiple past employers. And so what I try to encourage people to do is try to gather all that money together in one account. Because what I see is if you kind of we talked about earlier, if you have 15 different bank accounts or 15 different accounts, you're trying to gather it, kind of try to make sense of it. So what I would say is at least be looking at the opportunity to maybe bring it all together into one account. So typically if it's a 401k or like a 403b, usually that can be rolled over into an IRA. And if you had a couple of little accounts and you put them together in one IRA, now you have an account that has a substantial amount of your retirement money in it. Now you pay more attention to it. Maybe you look at how to invest it a little bit more rather than the 401k where you might just kind of set it and forget it. I think the 401k advantage is usually there's low cost to keep money in the plan. But if you're no longer with that employer, you don't get the matching contribution, you don't get any of the financial education, you don't get any information, like you get nothing. And so I think to keep it there because it's low cost, you could potentially, pay a little bit more, but have a more focused retirement plan that you're really paying attention to. I think that would be my goal. And I think I see a lot of people either cash out old retirement plans because, oh, it's only $7,000. Like, well, only $7,000, but now you're paying a penalty and taxes. And now that's $7,000 less to grow to have when you're 85 years old. And so I think that's just, I wouldn't be short-sighted about that, but I see that happen all the time. But I'd say, again, if you can bring it all together, and kind of put it in a place where you're really going to watch it. And then you could potentially add to it. I mean, if you put that IRA together, maybe you can make contributions and now you can actually be adding to that over the next couple of years while you're saving.
Thank you. And thank you to all of our panelists today for your responses, your presentations, very helpful information in terms of our financial wellness. And at this point, I'm going to toss it back to Amy and Sahadi.
Thanks, Ginger, and thanks to the panel. Holy smokes, there's been a wealth, a wealth of information that's been shared through all of you. And a couple of things that really stood out to me amongst the wonderful information and advice that you've given. And I think Lily started it out really well to say financial planning is an adventure. She sort of put it in the context of it shouldn't have to be, but we've had, I think, a pretty positive adventure here today. And so it's been really interesting. A couple other things, Jen Ridley Hanson said, financial planning wellness covers a broad spectrum and looks and feels different for each person. And so really wanting to reinforce that your story is your story and your outcomes are your outcomes. And there's a lot of support that you can get along the way to make that work for you. And then the other big thing was Jen Hannon, everyone needs an estate plan. And that just really, I think, resonates. I do have one, but it even makes me think, gosh, maybe I need to go look at that again just to make sure. And it wasn't that long ago. So the other reminder is, even if you have some of these things in place, to keep attending to them and don't just always kind of let them ride as things change for you and in your life. So thank you. We are so very grateful to all of you talented women who have helped us here and all of you wonderful folks who have attended as well. This is us all together embodying women, helping women, and it feels and looks just super amazing. If you submitted a question that didn't get answered, we do plan on answering those questions in a post-event email. So you will receive that within a couple of days. We need to let our experts sort of have some time and make sure that the answers get done appropriately and correctly. As promised at the beginning, I mentioned that we have a survey for our guests to fill out, and there will be a form, I believe, link. Is that correct in the chat? But we do have a survey for you all to fill out. All survey participants will be entered into a drawing to win that $100 gift card to Gail Ambrosius Chocolates. Yum, yum. And thank you to the United Way Foundation for sponsoring the event and gifting that to one of our audience members. If you provide your email in the survey response, we will reach out to the winner of the drawing as the results are compiled. So please give us your feedback and also tell us who you are.
Awesome. Thank you so much for that, Amy. I too just want to personally share that this has been so insightful. A few years back, I was an individual who knew nothing about credit and who had this dream of purchasing my own home. And in the span of 2 years, I did as much research as I could and went from a 420 credit score to a 700 and bought my own house. It would have been so helpful to have one of these available to me and just, you know, questions that I could have had answered. So thank you so much for that. In the chat, you'll find a form where you can tell us more about your experience today and register for our next event, which is on March 8th. We're excited to host another round of SAFE mentoring to honor International Women's Day, and you will not want to miss that. So thank you to our wonderful volunteers for planning this event, to our moderator, our panelists, for your wisdom, and thanks to you, our members and our guests, for participating and sharing today. We hope you leave today feeling empowered to make important moves and decisions that get you closer to financial security, whatever that looks like for you. If you enjoyed the content today and want more free and accessible opportunities for personal and professional development, become a member of Women United and follow us on LinkedIn. Thank you all again so much. Stay safe and stay warm, or as much as possible, I should say, and have a wonderful rest of your day. Thank you.